The IRS wants you to use this tax method, first in, first out, because generally, over time, they get more money. So why would an investor choose this method? Well, if someone is a long-term investor, using first in, first out could lead to some major tax advantages. But what if someone is a short-term trader? What if they trade by the week, the month, or even within the same year? Well, there are two other tax methods that the IRS doesn't really talk about. But in this video, I'm going to break them down for you. And if it's the first time you're doing crypto taxes, it's big because once you choose a method, it's very difficult to switch the method in future years. And starting off, first in, first out. And the goal of crypto taxes is figuring out what we paid for something and then what we sold it for. If we bought it for 10 and sold it for 20, that's a $10 gain. If we bought it for 10 and sold it for 15, that's a $5 gain. Also, there are losses. If we bought something for 10 and then sold it for 5, that is a -5 loss. So let's say we sold a coin for $15. Well, what is the basis price? What did we pay for it? So with first in, first out, we go all the way back in time to the first time we paid for an asset. So in this case, we paid $5 for this coin, and then we sold it for 15. That is a $10 gain. And I'm keeping this example very simple. We have a coin we bought on February 2nd, then a coin we bought on February 5th, 2021, and then another coin we bought for $7 on February 25th, 2021. So again, in this case, first in, first out. So first in, first out, we have a $10 gain. And the IRS likes this method because typically over time this leads to bigger gains, meaning they get more tax money. It's not a guarantee. Sometimes we invest in things for the long term and they perform very poorly. Sometimes they go to zero. But for the most part, this is how the IRS gets the most money. So why would we as investors ever choose this method? Because we want the highest basis price. If we look at these three coins, we wouldn't want this coin to be the basis price. We would want this coin to be the basis price. This higher basis price would lead to lower gains on paper, meaning that we pay less taxes to the IRS. Well, the reason someone would choose first in, first out is because it increases the chances of long-term capital gains. If we look at these three coins, this first coin we bought on February 2nd, 2021, and then sold for on February 15th, 2022, is more than 1 year later. And in the United States, if you hold an asset for more than 1 year, you get long-term tax benefits. Because for example, if we took this basis price over here of $7, which is higher than 5, which is what we want, but it was less than a year holding, well, we're gonna end up paying short-term capital gains. And we can see the difference here. For 2022, short-term capital gains can range from 10% all the way up to 37% based on your taxable income. But if we look at long-term capital gains, in this case, crypto held for more than 1 year, it's a lot lower. It ranges from 0% all the way up to 20%, again, based on taxable income. So long-term investors may prefer first in, first out. But what if you're someone who trades crypto by the week, the month, or even within the same year? Well, there are two other methods that may benefit you. Last in, first out, and highest in, first out. And at this point, you might be thinking, I get it. We're trying to figure out what we paid for something and what we sold it for. But this is super complicated. How do I do this myself? And the answer is, you don't. You use a tax calculator. For me, I've been using CoinLedger for the past few years. And if I go into their settings, there's a simple report calculation method drop-down menu, and I can choose first in, first out, last in, first out, or highest in, first out, and it does all the work for you. I will leave a link for CoinLedger down below. There is a discount code if you want to use it for your 2022 taxes. And the second method we're going to talk about is last in, first out. This method to me makes the least sense, but I'm quickly going to review it so that you understand. So again, we sold a coin for $15 on February 15th, 2022, and we're looking for the basis price. So last in, first out. So we go over here. This is the last time we bought this coin for $7, giving us a capital gain of $8. And when we look at last in, first out, it does not guarantee we're going to get the highest basis price. If we look at these three coins, this coin over here for $10, this is the highest basis price, not this coin over here. So first up, last in, first out simply takes the last time you bought a coin. It doesn't get you the highest basis price. And also, because you're getting the last coin that you bought, this reduces the chance of you getting long-term capital gains. So in this case, we bought a coin on February 2nd, 2021, February 5th, 2021. And if we sold any of these coins at this date, February 15th, it would be more than a year later. But in this case, this last coin we bought on February 25th, 2021 is less than 1 year later. So in this case, number one, we're not getting the highest basis price. And number two, we're not getting long-term capital gains. So the other method that may be more advantageous for short-term traders is highest in, first out. This is not based on time. Instead, this is simply based on the highest price you paid for a coin, which is what we want. We want a high basis price because this leads to less gains on paper, meaning we pay less tax to the IRS. So in this example, we sold a coin for $15. Then we go back to our buy dates and we see we have one for 5, 10, and 7. We simply take the highest. So over here, $10. So our gain is $5. And when using highest in, first out, it's also possible that we get long-term capital gains as well. In this example, the highest price we paid was on February 5th, 2021. And then when we sold it more than a year later on February 15th, 2022, we got the least capital gains on paper and we got long-term tax benefits. Again, if we're living in the United States. But then there's cases when using highest in, first out, we don't get long-term tax benefits. In this example, if we look at the highest price we paid for a coin, it was actually $12, but on February 25th, 2021, and then when we sold it on February 15th, 2022, that was less than 1 year later. So we have the highest basis price, which is good, but we didn't get the long-term tax benefits. So with last in, first out, you're not guaranteed to get the highest basis price, and you're also reducing the chances of getting long-term tax benefits. But with highest in, first out, you are getting the highest basis price, and also there is a chance you get long-term tax benefits. So for those that are short-term traders, highest in, first out may be very beneficial. But for those that are long-term investors that want those long-term capital gains, first in, first out is another popular method. And if you need help with any of these methods, go ahead and check out CoinLedger in the description down below.